Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of How to Analyze a Balance Sheet, a simple guide to financial insights. A balance sheet is more than just numbers on a page. It's a snapshot of a company's financial position. By analyzing it, you can uncover key insights about assets, liabilities, and equity, helping you gauge stability and growth potential. Whether you're an investor, business owner, or student, understanding this tool can guide smarter financial decisions. Understanding the balance sheet. A balance sheet is one of the most important financial documents for any business. It provides a snapshot of a company's financial health at a specific point in time. By understanding its structure and components, you can gain insight into how assets are funded and how liabilities are managed. Whether you're an investor, a business owner, or someone curious about finance, knowing how to read a balance sheet is essential. Key components of a balance sheet. The balance sheet is divided into 3 main sections: assets, liabilities, and equity. Each plays a distinct role in outlining a company's financial standing. Assets. Assets are everything a company owns that has monetary value. They're usually divided into 2 categories. Current assets. These include cash, accounts receivable, and inventory, resources the business expects to use or convert to cash within a year. Non-current assets. These are long-term items like property, equipment, and investments, which take longer to convert to cash but are critical for operations. Liabilities. Liabilities represent what a company owes to others, like loans and unpaid bills. These are also categorized. Current liabilities. Debts or obligations due within a year, such as accounts payable or short-term loans. Non-current liabilities. Long-term debts, like mortgages or bonds payable, that extend beyond a year. Equity. Equity reflects the value left in the business after all liabilities are subtracted from assets. It's often referred to as the owner's claim on the company. This section includes items like retained earnings and shareholder contributions. Each of these components tells a unique story about how a business is structured and operates. The accounting equation. The balance sheet is built on one simple yet powerful principle: the accounting equation. It states, assets equals liabilities plus equity. This equation shows the relationship between a company's resources, debts, and ownership. Here's how it works in practice. Assets, everything the company owns. Liabilities, what the company owes to creditors. Equity, the portion of ownership belonging to the shareholders or owner. Think of it like a pie. The total pie, assets, must always equal the sum of its slices, liabilities and equity. If a company borrows money to buy equipment, both assets and liabilities increase equally. If profits are retained, equity grows while assets stay balanced. This equation ensures that a balance sheet always stays accurate. Once you understand it, you'll be able to spot trends like overleveraging or underutilization of equity that could impact the business. By breaking down the balance sheet into these key components and understanding the accounting equation, you'll have a solid foundation to analyze financial health more effectively. Types of assets. Assets form the foundation of a balance sheet, representing what a company owns and uses to generate value. These resources are typically divided into 2 broad categories: current assets and non-current assets. Understanding the distinction between these types is key to analyzing a company's financial health and operational efficiency. Let's break them down. Current assets. Define current assets and provide examples. Current assets are short-term resources expected to be converted into cash or used up within 1 year. They are essential for covering day-to-day expenses and managing short-term obligations. Think of them as the most liquid part of a company's resources, ready to move at a moment's notice to keep operations running smoothly. Examples of current assets include cash and cash equivalents, money in hand or in easily accessible accounts. Accounts receivable, payments the company expects to collect from customers. Inventory, goods available for sale, including raw materials, finished products, or work in progress. Prepaid expenses, payments made in advance for services or goods, like insurance premiums. For a business, current assets act like fuel in a car. Without them, daily operations can come to a screeching halt. The higher the current assets, the better a company's ability to handle its short-term needs. Non-current assets. Define non-current assets and provide examples. Non-current assets, on the other hand, are long-term investments that a business doesn't intend to convert into cash within a year. These resources play a crucial role in generating value over time. Think of them as the building blocks of a company's future. Examples of non-current assets include property, plant, and equipment, PPE, physical assets like buildings, machinery, and vehicles used in operations. Intangible assets. Non-physical resources like patents, trademarks, or goodwill. Long-term investments. Stocks, bonds, or other securities intended to be held beyond a year. Deferred tax assets. Taxes owed to the company that will reduce future tax burdens. Non-current assets are less liquid but just as vital. Imagine them like an anchor. They hold the business steady and support growth, even if they're not constantly in motion. For example, the right piece of equipment can boost production for years, making it a strategic investment. By understanding current and non-current assets, you can better assess how a company balances short-term flexibility with long-term stability. Each type serves a distinct purpose, and their composition can reveal a lot about priorities, strategies, and risks. Types of liabilities. Liabilities represent what a company owes to others, from short-term bills to long-term loans. They are a critical part of the balance sheet because they show how a business funds its operations and obligations. Understanding liabilities is key to assessing a company's financial stability and risk exposure. There are two main classifications: current liabilities and long-term liabilities. Current liabilities. Define current liabilities and provide examples. Current liabilities are debts or obligations a company needs to pay within 1 year. These short-term commitments often arise from day-to-day business operations and must be managed carefully to maintain smooth cash flow. Essentially, current liabilities show how much a company owes in the near term. Examples of current liabilities include accounts payable, unpaid bills for goods or services the company has received, such as supplier invoices. Short-term loans, borrowed funds that must be repaid within a year. Accrued expenses, costs incurred but not yet paid, like employee wages or interest on loans. Taxes payable, income tax or sales tax owed to government authorities. Unearned revenue, payments received in advance for goods or services the company still needs to deliver. Think of current liabilities like monthly bills at home. They're unavoidable and must be paid to keep things running. A company with strong current assets is in a better position to handle these fast-approaching obligations without financial strain. Long-term liabilities. Define long-term liabilities and provide examples. Long-term liabilities, in contrast, are obligations that don't need to be paid within 1 year. These often fund major investments or operations, such as purchasing equipment or expanding facilities. While they are less urgent than current liabilities, they can significantly impact the company's long-term financial health. Examples of long-term liabilities include loans and bonds payable, debt instruments like bank loans or bonds issued to investors, often spanning several years. Mortgages, long-term loans secured against property or real estate owned by the business. Deferred tax liabilities, taxes owed in the future due to temporary differences in accounting practices. Pension obligations, money owed to employees as part of retirement benefits promised by the company. Picture long-term liabilities like a student loan. It helps achieve something big, like earning a degree or buying equipment, but it must be repaid over time. Managing these debts effectively ensures that a company can maintain stability and growth without being overwhelmed by financial burdens. By understanding how liabilities are classified, you get a clearer picture of what a company owes now versus later. This breakdown can help you evaluate whether the business can meet its obligations while still investing in its future. Equity section of the balance sheet. Equity represents the ownership interest in a company. It's what remains after subtracting liabilities from assets. Think of it as the company's net worth, a reflection of the stake owners or shareholders hold in the business. On the balance sheet, the equity section provides insights into how much of the company is funded by its owners instead of creditors. Owner's equity. Owner's equity includes two primary components: contributed capital and retained earnings. These two parts tell the story of how the business is funded and how profits are managed. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.